Hello friends, welcome to Advanced Capital Budgeting Decisions. So this is a very important chapter for the coming syllabus. But in your CA final syllabus, the topic starts from where it ends in the intermediate. We are not going to discuss again how to calculate NPV, how to calculate IRR, or how to compute profitability index. That those basic calculations you have already studied. Here we are going to take advanced concept with focus on two important areas. One is inflation and capital budgeting, and second risk analysis. Under risk analysis we have many subtopics that we'll discuss. So first we'll begin with inflation. Inflation and capital budgeting. Inflation and capital budgeting means, suppose you predict revenue of year 1, 2, 3, 4 will be as follows. Cost of year 1, 2, 3, 4 will be as follows. 50 crore, 60 crore, 70 crore, 75 crore. Revenue you may predict like this. But what can happen because of inflation? What you have predicted and what may be the actual outcome may be different, because next year because of inflation the cost may increase, because of inflation the revenue may be higher. Therefore, while making projections about revenues, cost or expenses, while making projections about revenue, cost, expenses and other thing, one should also take care of inflation, because inflation can affect the purchasing power. Without inflation it might seem you are making profit, but when you also consider inflation effect, then probably it may be a loss making proposition. Okay, it may be a loss making project. So therefore one has to also consider inflation in decision making. The impact of inflation is erosion of purchasing power of money over a period of time. The finance manager has to measure the impact of inflation on his decision. In your intermediate, whatever problem you have solved of capital budgeting, you never considered about inflation. Whatever figures were given, you have taken as it is. Life is not so simple, because once you start the project there can be inflation. Inflation can be in terms of both revenue also and cost also. So therefore what you predicted may not be true, hence he has to consider inflation while making decisions. Inflation can affect your dividend payout policy, capital restructuring, depreciation, profit, working capital, tax planning. But we are more interested today in the impact of inflation on capital budgeting, because that is our topic. Inflation can affect so many other areas in business as they have mentioned it. So let us start with some basic knowledge about inflation and capital budgeting. Our discussion would be only about inflation and capital budgeting. Okay, so first concept is called nominal or monetary or out of pocket cash flow. Nominal or monetary or out of pocket cash flow. Suppose you buy this pen today and the shopkeeper tells you this pen is going to cost you 100 rupees. This pen is going to cost you 100 rupees. Option A, is this 100 rupees nominal cash flow or is this 100 rupees real cash flow? Today if you buy this pen for 100 rupees, is it a nominal cash flow or is it a real cash flow? Just make a guesswork. Option A is the right answer. It is called nominal cash flow. Nominal cash flow means cash flow includes inflation. Cash flow includes inflation. It is also called monetary cash flow. It is also called out of pocket cash flow. It means the amount we pay to the shopkeeper is nominal cash flow because it is at present price level. It is at current price level. And suppose I say if there was no inflation, because in last year the inflation was 10%. If there was no inflation, the price of the pen would have been 100 divided by 1.10, 90.91. If there was no inflation, it is a hypothetical calculation. If there was no inflation in the current year, then what would have been the price? 90.91. What will you call it? Real or nominal? Real. Real means price does not include inflation. So real is at constant purchasing power. Real is at constant purchasing power and nominal is at current purchasing power. Current purchasing power means today's price level, and constant purchasing power means if there was no inflation, then what will be the price? So transactions takes place at nominal values. Okay, transaction takes place at nominal values, keep in mind. Now similarly, just like you have nominal cash flow and real cash flow, you have nominal discount rate and real discount rate. Nominal discount rate is also called money discount rate. Nominal discount rate includes inflation. Nominal discount rate includes inflation. It means the discount rate also takes care of the inflation premium. An investor would not only want to be compensated for the real return, he will also want to be compensated for the inflation. Otherwise he would lose. Because if your cash flow is including inflation, the discount rate must also include inflation. Otherwise your comparison is not appropriate. And what is real discount rate? Real discount rate means the discount rate does not include inflation. Discount rate does not include future inflation. So I repeat one more time, nominal cash flow includes inflation, real cash flow does not include inflation, nominal discount rate includes inflation, real discount rate does not include inflation. Nominal cash flows will be discounted using nominal discount rate, and real cash flows will be discounted using real discount rate. So this is called golden rule of discounting in this chapter. Real cash flow will be discounted using real discount rate. Nominal cash flow will be discounted using nominal discount rate. And now we will see how to convert real cash flow into nominal cash flow and nominal cash flow into real cash flow. Is it right? Very easy. Suppose in year 0, this pen price is 100 rupees. Inflation is 10%. Inflation is 10%. What would be the price of this pen after 1 year? If the inflation is 10% and price of the pen today is 100 rupees, 110. So what you will do? You will take 100 into 1 plus 10% to the power 1. What will be the price of this pen after 2 years now? If inflation continues to be 10%, 1 to 1. So then you will take 100 into 1.10 to the power 2. The effect of inflation is cumulative. The effect of inflation is cumulative. What is that? It means next year 10% will be applied on 110 rupees. If the inflation continues to be 10% per annum, next year it will be applied on 110. So effect of inflation is cumulative. Therefore, the formula also looks like a compound interest formula. Can you see that? But it is not interest. We are not computing interest. We are computing the nominal cash flow by applying inflation rate. Just like in compound interest, you have interest on interest. Similarly, in case of inflation, the effect of inflation is also cumulative. Okay. Next year, the inflation applies to 110, and now we can do reverse working also. Now we can do reverse working. So this is my nominal cash flow. If from nominal cash flow I have to find real cash flow, I will change the formula, nominal cash flow upon 1 plus inflation rate to the power n. Okay. So this formula is just the same formula redesigned. Next formula is for nominal discount rate and real discount rate. Okay. Suppose real discount rate is 10% and inflation rate is 10%. Then the question will be, what will be nominal discount rate? What will be nominal discount rate? So normally people will say nominal discount rate will be 10 plus 10, but it is not 10 plus 10. It is 10 plus 10 plus 10% of 10. That is 120. That is 21%. So how do I get it? By the formula. 1.10 is my real discount rate. 1 will become 1.10. Inflation will be added to 1.10. The effect of inflation will be on 1.10. And then when you deduct minus 1, and for percentage you multiply by 100, you will find your answer is 21%. The answer is 21%. Is it right? That is called nominal discount rate. So nominal discount rate you can find from real discount rate and inflation. The formula is 1 plus RDR into 1 plus inflation rate minus 1. Why inflation is also applied to real discount rate? Yes or no? Why don't we just add 10 plus 10? Okay. So suppose you have a bat, cricket bat, because there is a India is obsessed with cricket. Yes or no? There are IPL, there are women IPL, T20, one day, test match, World Cup, one or the other thing keeps on moving. So cricket bat suppose cost 100 rupees at the beginning. Okay. But then the manufacturer improved the quality of the cricket bat. Manufacturer improved the quality by adding some more feature. Because of the improvement in the quality, he is saying that now I will sell you this bat for 110 rupees because I have added some feature, something extra, whatever, extra glue, better whatever you call it. Okay, handle, quality of handle, grip. Okay. But then during this 1 year period, the price of the wood, the glue, the rubber has also increased by 10%. This 10% was due to quality, features, and then there was a 10% increment because the same items is now going to cost 10% more. The wood, the rubber, the glue. So now he says I would charge you 121. So the 10% inflation will be applied on 110. So if I want to find out what is the nominal discount rate or nominal value, I will take 100 into 1.10 for quality, which is like real discount rate, into 1.10 for inflation, n minus 1. So I will say the price of the bat has increased by 21%. But out of 21%, 10% was due to quality, 10% was due to inflation. So why it is not 20? Because that 10% inflation is also on quality part. So using the same logic, NDR is equal to 1 plus RDR plus 1 plus inflation minus 1. And from the same formula, we can do reverse working and find out the real discount rate. So real discount rate will be 1 plus nominal discount rate divided by 1 plus inflation rate minus 1. So 4 formula we have learned: nominal cash flow, real cash flow, nominal discount rate, real discount rate. Important point number 1, all cash flows must be consistently written either in monetary terms or in real terms. In capital budgeting problem, all cash flows must be either in real term or nominal term. That means sale, expense, tax, everything should be in real terms or in monetary terms. Nominal cash flow, golden rule number 1. Golden rule number 1, nominal cash flow will be discounted at nominal discount rate. Real cash flow will be discounted using real discount rate. Nominal cash flow should be discounted at the inflation rate to arrive at real cash flow. So what they are saying, real cash flow basically already discussed is equal to nominal cash flow upon 1 plus inflation rate to the power n. The meaning of this last point is, if you want to convert nominal cash flow into real cash flow, you have to discount by the inflation rate. Formula is already printed in the notes. Is it there? Real cash flow is equal to nominal cash flow upon 1 plus inflation rate to the power n. Point 7, real cash flow should be computed at the inflation rate to arrive at the nominal cash flow. That is, once again, nominal cash flow equal to real cash flow into 1 plus inflation rate to the power n. Now we'll draw one diagram in your book, or you can write in the notebook. Right. You can start writing. In the center of the page, write NCF, nominal cash flow. Below that, real cash flow. Write in the notebook or in the book. Present value. Now, first golden rule, nominal cash flow will be discounted using nominal discount rate to arrive at present value. Okay, if you are given nominal cash flow and nominal discount rate, life is easy. Life is easy. Okay, but if you are given real cash, if you are given real discount rate, if you are given real discount rate but nominal cash flow, then what will you do? You are given, what is given? Real discount rate and you are given nominal cash flow. What will you do? You will first convert nominal cash flow into real cash flow. First you will discount nominal cash flow by inflation, you will get real cash flow, and then you will use real discount rate to arrive at present value. Okay, one more question. If you are given real cash flow and nominal discount rate, then what will you do? You can first convert real cash flow to nominal cash flow. You will first convert real cash flow to nominal cash flow by adding inflation and then divide by or discount by nominal discount rate. So did you like this diagram? Innovative diagram. Okay, those who have liked it will say yes. Yes. So in your exam, they will not give you nominal, they will not give you real. Because if real and real both are given, there is no need to do any adjustment. Directly apply discount rate. If they have given nominal cash flow, nominal discount rate, directly apply the adjustment. So in most of the question, real cash flow is given in most of the question and nominal discount rate is given. Then we'll have to first convert real cash flow into nominal cash flow and apply the nominal discount rate. Next point, depreciation and inflation. Depreciation is charged on historical cost. Do you remember? Income tax law does not allow inflation based accounting. Income tax only allows depreciation based on original purchase cost. So depreciation is not subject to inflation. Depreciation is not subjected to inflation. Even if they say inflation rate is 10% for the company, it is not applicable for depreciation, because the role of depreciation in capital budgeting chapter is it is a tax deductible expenditure, but the depreciation allowed will be only on historical cost, not on the basis of current value of the asset. If the asset is purchased for 10 lakh rupees, depreciation rate is 20%, you have to compute 10 lakh into 20%. What about taxes? Do we pay tax to the government, option A, using nominal cash flow, or do we pay tax to the government using real cash flow? Give me the answer, option 1 or option 2. Taxes are paid real. What is your name? I will complain to the government. Taxes are always paid on nominal basis, today's value. Today you will go and pay tax to the government. It is at today's value. You can't tell the government, I will pay you at 1991 price level. Can you say that? No. Indexation is not applicable while paying amount of taxation. Tax will be paid at today's value. So if, golden rule again, if you have to compute taxation in a problem, it has to be always on nominal basis. Taxes are always paid on nominal basis, today's value basis. Okay, don't make that mistake. There are two types of inflation in the current chapter. One is called symmetrical inflation and the other one is called non-symmetrical inflation. What is symmetrical inflation? Symmetrical means all items of revenue and cost are subject to same rate of inflation. That means revenue subject to 5% inflation. Cost items, whether variable cost, fixed cost, are all subject to 5% inflation. So inflation is same for all cash flow items. Symmetrical. Symmetrical means same. If nothing is given in the problem, only one inflation rate is given, then assume symmetrical. But there can be a question of non-symmetrical inflation also. So what is a non-symmetrical inflation? Revenue may be subject to, say for example, 5%. Variable cost may be subject to 6%. Fixed cost may be subject to 7% inflation. Is it right? Rent may increase by 7% every year. Rent is a fixed cost. In all your intermediate problem, rent was constant for 5 years. Which landlord will keep rent constant for 5 years? Which employee will keep salary constant for 5 years? Your stipend is also increasing by 20% every year or not? 20%? Don't know. So that is called non-symmetrical inflation. Okay. When items of revenue and cost are subject to different rates of inflation. Next point, in case of non-symmetrical inflation. Now this is a little difficult question. Non-symmetrical inflation, what we'll do? First we will convert all cash flows into nominal, and then use nominal discount rate. So whenever the problem is of non-symmetrical inflation, it is advisable that first you convert, this is what we are going to do, all cash flows into nominal and then use nominal discount rate, or first convert all cash flow into that form in which the discount rate is given. So I have seen in all questions the discount rate given is nominal. So better you convert all cash flows into nominal cash flows. Is it right? Next point, problems in investment decision due to inflation. One theory paragraph and then we'll take a few questions on inflation. Is it right? So basic rule you have understood. What are the problems while dealing with inflation and decision making? First of all, as all of you know, it is difficult to forecast inflation. Okay, even the finance ministry does not accurately forecast inflation. Even RBI cannot forecast inflation with certainty. Second thing, difficult of predicting demand and other factors which may be affected by the level of inflation. Second problem is, if there is an inflation, price will rise. But because of the price rise, how the demand will be affected, we don't know. In all your question, you will be given a quantity sold is 5 lakh unit per annum. But it is not going to be like that. If the price level goes up and if the product is price sensitive, the demand can fall, but difficult to estimate. And third problem is whether to express forecasted cash flow in real term or nominal terms. So these are all for theory questions in the exam and for some MCQ question if they ask you. Now the time has come to solve one very important question on inflation. Consider the following information relating to a project that involves an outlay of rupees 10,000 in year 0. Year 0 investment is 10,000 and yields an annual inflow of rupees 3,000 in real terms. They have computed this 3,000. Can you see 3,000 in this table? In real terms, that is given in real terms, means excluding inflation, at constant purchasing power. Depreciation is on SLM basis. SLM, what is SLM? Straight line method, equal amount of depreciation every year. Salvage value is 0. Very good. All cash inflows are subject to inflation of 7%. Cash inflow means sales. Sales will be subject to 7% inflation, while all cash outflows are subject to an inflation of 8%. So cash expenses will be subjected to 8% inflation. And then it says nominal discount rate is 14%. So what I'll do, this is a problem of non-symmetrical inflation, also called asymmetrical inflation, asymmetrical, written in the heading. Okay, so this is one example of non-symmetrical inflation. So now let us look at the calculation: sales, expense, PBT, tax. So what we have got, tax rate 60%. So that means we have to first compute the entire problem in nominal terms because I have to compute tax. Second reason why we have to compute in nominal term, discount rate is given in nominal terms. So this problem we are going to first convert all cash flows into nominal terms, find out nominal cash flow and then compute present value. PAT is given, depreciation tax shield is given. Can you see depreciation amount is 2400? Can you see the cost of the asset is 10,000 and salvage value is 0? So will you do reverse working and find out what is the life of this project? Life 10,000 is the cost, annual depreciation is 2500. So it's very simple, the life of the project will be 4 years. That was not mentioned in the problem. That is the strategy of the institute to test you. And this net cash flow is real. We don't have to use this. What we have to use? We have to use nominal cash flow. Evaluate the project for its acceptability. Very good question on inflation. First, write down step 1. Write in the notebook. Write nicely. You will get all the concept in this chapter and practice more. Practice more. Step 1, write down life of the project. Life of the project is equal to 10,000 cost divided by annual depreciation 2500, 4 years. Is it 4 years? Step 2, write down calculation of NPV. Calculation of NPV. Calculation of NPV. Calculation of NPV. Draw one format. Year, particular, cash flow, discounting factor, discounted cash flow or PV. Year 0, write down cost of the project. Cost of the project. Year 0, cost of the project 10,000. Year 0, cost of the project 10,000. Year 1, 2, 3, 4, write down CF80. Working note 1 below. Working note 1 below. Working note 1 below, write down working note 1, CF80. Working note 1, keep 3 lines blank and write CF80. Serial number, particulars, year 1, 2, 3, 4. What about salvage value? 0. What about working capital? 0. Not given? Ignore. Whatever is not given, ignore. If working capital is given, you will write it. So you start with sales. Like a normal P&L account, we will prepare. But sales are given in real terms, 7,000. Write down. I need to convert sales into nominal. Right below, sales nominal equal to real cash flow into 1 plus I to the power n. Now let us look at the question. What is the inflation on revenue? 7%. So how do you get the answer here? 7,000 plus 7%? 7490. Again 7% because the real amount is equal. The real cash flow is equal. So you just keep on adding 7%. 8014, third year. 8575, next year. 9176. Check the answer. Same way, write down cash expenses real. Cash expenses real. Cash expenses real. 3250. 3250. Cash expenses real. Now write down cash expenses nominal. Cash expenses nominal. Under that write down nominal equal to real cash flow into 1 plus I to the power n, where I is equal to 8%. Where I is equal to 8%. This is a question on inflation and capital budgeting, and this is a problem of non-symmetrical inflation. So take on your calculator 3250 plus 8%, 3510, again 3791, again 4094, again 4422, correct? Now write down depreciation. Depreciation calculation is already printed in the question book. 2500 printed. Bracket write down given. Then write down point F PBT. PBT will be B minus D minus E. B minus D minus E. Sales nominal, cash expense nominal minus depreciation. Come on, gentlemen. 1480. Next one. 1723. Come on, gentlemen. Next. 1981. Next. 2254. Tax at the rate 60%. Tax at the rate 60%. Now I will tell you how to do it fast. First number you type 0.6 into 1480. Press equal to 888. Now only type 1723 and press equal to. You will get the answer 1034. 1981 equal to 2254 equal to 2254 equal 1189. Next one. 1352. Is it right? 1352. If you have to multiply by the same number every time, first number you take that constant number with which you have to multiply, and next time only type the number and press equal to, you will get the answer. Now the next task is CFAT nominal. CFAT nominal, how do you compute? One method is cash inflow minus cash expense outflow minus tax outflow. Is it right? So the highlighted ones, come on. First year 3092, the highlighted one. Next year, come on, 3189. Next year 3292. Next year 3402. This is called nominal CFAT. One more way you can do it if you want to know how to do it, or you can write here, or F minus G plus E. Answer will be same. F, what is F? PBT minus G, tax, add back depreciation, you will get same result. You can try later as homework. These numbers you transfer to the main page. Go to the main page above. Main statement. This is the main statement. Write down here 3092 3189 3292 3402 and use 14% discount rate. Use 14% discount rate. Use 14% discount rate. Please respond. What is the NPV? Final answer. Final answer. What is NPV? What is NPV? NPV. Negative 597 is right. Negative 598 is also right. Okay. So this is a good question on understanding the role of inflation in capital budgeting. Advice, write down. Advice. Company should not accept the proposal. Company should not accept the proposal as the NPV is negative. Company should not accept the proposal as the NPV is negative. Is the answer right? And conclude the answer by writing project should not be accepted because the NPV is negative. All of you are requested to write in the notebook. This will be a very complete holistic revision of your capital budgeting chapter. Now come to next question number 2. A firm has projected the following cash flow from a project under evaluation. Year rupees in lakhs. Year 0, 1, 2, 3 rupees in lakhs. The above cash flows have been made at expected prices after recognizing inflation. Now what does that mean? Option A, these cash flows are real. Option B, these cash flows are nominal. Read the line and give me the answer. Whether cash flows are real or whether cash flows are nominal. Are after recognizing inflation. So this is nominal. These cash flows are in nominal terms. These cash flows are in nominal terms. You can't miss that line, otherwise your answer can go wrong. The firm's cost of capital is 10%. Expected annual rate of inflation is 5%. Another question for you. Please respond. Let me see, are you listening to me or not? Whether this cost of capital, option A, is real discount rate or nominal discount rate. 10%, real discount rate or nominal discount rate? Nominal, real. Some students are saying real, some are saying nominal. The answer is real. Why? Because if this is nominal, then there is no need for this line. If you assume this is nominal, then what is this line doing here? Not required, because cash flows are already nominal. And if you assume discount rate is also nominal, like a intermediate first question, find the NPV. So we are going to interpret that the cost of capital is real, and you need to convert either nominal cash flow into real cash flow or real discount rate into nominal discount rate. Then only we can solve. So what I'll do, I'll solve it 2 times. I will solve it 2 times. First time I will convert real discount rate into nominal discount rate and solve, and second time I will convert nominal cash flow into real cash flow and then use real discount rate. Write one note in the beginning of your answer. Note, it is assumed that the cost of capital, it is assumed that the cost of capital given in the question, it is assumed that the cost of capital given in the question is in real term. It is assumed that the cost of capital given in the problem is in real terms. Understood? Right. So first write down method 1. Using nominal discount rate. Sometimes in the exam they will tell you specifically compute NPV using nominal discount rate. Then you don't have a choice. Then you have to first find nominal discount rate. Write down please calculation of nominal discount rate, NDR. formula NDR is equal to, already explained to you with the help of one example of a bat. Okay, why we do like this? 1 plus real discount rate into 1 plus inflation rate minus 1. What is the answer? 1 plus 0.10 into 1 plus 0.05 minus 1. Anybody who would like to answer? 15.5%? Is it 15.5%? Right. You have to write nicely, because one day you have to appear in the exam and you have to present the answer like this only. Presentation is also important. Now write down step 2, calculation of NPV. Format, basic format of capital budgeting NPV calculation. Year, particular, cash flow, discounting factor, at the rate 15.5% and discounted cash flow. Right. So first we will write down year 0. What is the transaction in year 0? Investment. How much? 70 lakh. At the top write down rupees in lakh. Year 1 cash flow 30 lakh, year 2 cash flow 40 lakh, year 3 cash flow 30 lakh. This is given in the problem. I have not done anything till now. Now my role starts. I will first compute present value factor at 15.5%. First, year 0 always 1. Then on your calculator 1 divided by 1.155 equal to 0.8658. Again press equal to how much? 7496. Again press equal to 6490. Now you multiply these two columns. Use memory plus function so that you can do it faster. Come on. 5 point final answer. Very good. One student has already achieved the answer, 5.428. Amazing. This is called method 1. Nominal cash flow will be discounted using nominal discount rate. So write down advice. Evaluate the project. So what advice you will write? Project should be accepted. Because the NPV is positive. This is NPV. Project should be accepted because the NPV is positive. Write down method 2. Method 2, using real cash flow and real discount rate. Heading write down using real cash flow and real discount rate. If they specifically ask you to use real cash flow and real discount rate for the same problem, how do you do it? 5 columns we are going to draw. First column, year. Second column, cash flow, nominal. Third column, cash flow, real. How do you convert nominal cash flow divide by 1 plus inflation rate to the power n? In the third column you write the formula nominal cash flow upon 1 plus I to the power n, and then you write fourth column discounting factor at 10%, fifth column DCF discounted cash flow, year 0 70, 1, 30, 2, 40, 330. Wait, how do you convert it? First year 0 same figure 70. Now type on your calculator 30 divided by 1.05 equal to 28.57. Now you type 40 divided by 1.05, press equal to 2 times 36.28. Type 30 divided by 1.05, press equal to 3 times 25.92. Please use 10% factor and solve and give me the NPV. Discounting factor 10%. Then multiply. Anybody who would like to give me the NPV in the last column? NPV in the last column, please reply. 5.42. Same answer? Same answer?
YouTube streaming on करते हैं.
करो. Any query on this now? No query. One more question will take. This question number 2 was from study material and past exam. Question number 3 is also from institute publications only. Okay. KLM requires rupees 15 lakh for a new project. Useful life of the project is 3 years. First you mark it very, very important. All 3 questions are very important. Salvage value is nil. Depreciation is 5 lakh. Given below are projected revenue and cost, excluding depreciation. Ignoring inflation means real cash flow. These cash flows are real. Our topic going on is inflation and capital budgeting. These 2 revenues are given, cost is given. This time revenues are different in different year. Cost are different in different year. Tax rate is 35%. Assume cost of capital to be 14% after tax. The inflation rate for revenue and cost are, and this time one more different variety of question. Inflation rate for revenue and cost are: first year revenue 9, first year this is inflation rate. And you can see in this problem the inflation rate is also different for different year. Very important, inflation rate is different for different year. So accordingly we will have to first compute the projected cash flow by applying different inflation rate. Very, very important question, and they have given you PV factor also at 14%. So what they want from you that you should use 14% discount rate. Show the amount to the nearest rupee in calculation you are required to compute the NPV of the project. So I am going to ask you one easy question. This cost of capital 14% after tax, and here they have given you PV factor at 14%. My question is whether this discount rate of 14% given in the question, option A is real discount rate, option B is nominal discount rate. Is 14% real discount rate or nominal discount rate? Because accordingly I need to solve. Haji, nominal. So the answer this time would be nominal. Is it right? Normally if they give you after tax, then you treat it like a nominal discount rate. Secondly, the another hint is that the factors are also given at 14%. So we'll have to use 14% as a discount rate after tax. So let us write one note again, because there is not 100% certainty it is a nominal, but from the overall drafting of the question, there is no other choice but to take it as a nominal discount rate, because there are so many inflation rate given. How do you reach the nominal rate? If you assume it is real, how do you reach nominal discount rate? You have been given so many different inflation rate. Then for each year also the discount rate can be different, right? So better we will assume it is a nominal discount rate. Understood? Write the note. It is assumed that the cost of capital given in the problem, it is assumed that the cost of capital given in the problem is nominal discount rate. Write a note in bracket. If discount rate is given after tax, one can safely assume it to be nominal discount rate. One can safely assume it to be NDR, nominal discount rate. Now let us come to the answer of this question. All of you will participate in the calculation. First write down the main heading, computation of NPV. Followed by the basic format of NPV calculation. Year, particulars, cash flow, PV factor at 14% and PV. Year 0, cost of the project, how much? 15 lakh in bracket. Present value 15 lakh. Year 1, CFAT nominal working note 1. We'll write down working note 1 after this. Same thing, write down year 2, CFAT nominal working note 1. Same thing, write down year 3. Now write down working note 1, calculation of CFAT. Nominal. Calculation of CFAT nominal. Year 1, 2, 3 on the right side. Year 1, 2, 3 on the right side. Revenue, write down real. 10 lakh, 13 lakh, 14 lakh. 10 lakh, 13 lakh and 14 lakh. 10 lakh, 13 lakh and 14 lakh. Then write down revenue nominal. Point number B. How do you get it? 10 lakh plus 9%. 10 lakh 90,000. Wait. What about second year? No. Second year my revenue itself is different. 13 lakh into 8. First you take 13 lakh into 1.09 will give you value after 1 year into 1.08 because it's after 2 year. 13 lakh is in real terms. First it will increase by 9% and then it will increase by 8%. 15, 30, 360, correct? Now you have got 14 lakh, but here the inflation effect will be 9%, 8%, 6%. So kindly write the calculation also. Anybody who is interested in answering? 1746,965. So this is the difference. 3 different variety of questions I have taken. You need to practice more. Write down cost. Write down real. cost real. What is the real cost? 5 lakh, 6 lakh, 6 lakh 50,000, correct? Can you see that in question? Now write below cost nominal, right below cost nominal 5 lakh into 1.10, 5 lakh into 1.10, 5 lakh 50,000. Next 6 lakh into 1.10 into 1.09, 719400. Please answer the last one. 6 lakh 50,000 into 1.10 into 1.09 into 1.07, 833,905. Wait, up to this we have done. You will continue below this. I am going to the next slide. You are going to write point number E below that. Depreciation. Depreciation 15 lakh divided by 3 years. Depreciation is not subjected to inflation. Depreciation is not subjected to inflation. It is based on historical cost. Next point, PBT, profit before tax, B minus D minus E. Please try B minus D minus E. Anybody? 40,000. Next year, come on, B minus D minus E. 310,960. Wonderful, very good. Next one, 413,060. 413,060. Now write down tax at the rate 35%. 0.35. First time you write 0.35 into 40,000. 14,000. 0.35 into 40. Now just type the number and press equal to 108886. Last one. Anybody? Last one. 144571. Very good. Now write down next point. CFAT nominal. Next point, CFAT nominal, B minus D minus G, B minus D minus G, B minus D minus G, or for those who want to write F minus G plus E, or F minus G plus E, both will give you same answer. You can try. Anybody? 5,26,000 is right. Come on, next, second year. Second year, please reply fast. 7,02,124. Very good. Last year, 7,68,489. Please check this last 3 line. Take this number to the main page. Take these numbers to the main page. This is the main page. Bring it over here. Bring it over here. 5,26,000. 7,02,124, 7,68,489, 1 divided by 1.14. Don't, I think factors are given. Please use the institute's factor. Use institute's factor and compute NPV. 19,965. 19,965. 19,965. Positive or negative? Positive. So write down one advice. Advice, write down. The project should be accepted. The project should be accepted because NPV is positive. Right? I will ask you to ask any query if you have. No query? No query. So these were three important questions on inflation and capital budgeting. Now we are going to discuss capital budgeting and risk analysis. This is the remaining part of this wonderful chapter where risk analysis has been given lot of importance. When you are evaluating capital budgeting proposal, it is subject to various degrees of risk. Why? Because you are estimating future cash flow. Future is fill in the blanks, certain or uncertain. Uncertain. Very good. And who knows it better than our students? Yes or no? Don't worry, your future is certain. If you work hard, then it is certain. So there are three types of decision making involved. There are three types of decision making involved. One is decision making under certainty. There is one concept in our chapter later called certainty equivalent cash flow. Certainty equivalent cash flow, where we are going to convert cash flows into certain cash flow. But later, this is also one type of problem. Second is decision making involving risk. Risk means deviation from expected outcome. What is risk? Deviation from expected outcome. What we expected and what can happen, there may be a difference, but probability can be assigned and therefore you can do analysis much better. Therefore you can do analysis much better. So cash flow will be 10,000 with 0.2 probability, 20,000 with 0.5 probability, 30,000 with 0.3 probability. In that case, we are saying that we are taking a decision involving risk. And there is one more situation when we are not able to assign probability. That is called decision making under uncertainty. Risk and uncertainty are similar terms. Risk and uncertainty are similar terms, but in capital budgeting chapter or in other chapters in our syllabus, if the probability can be assigned, then we'll say it's a risky situation. If probability cannot be assigned, uncertain situation. Example, two students have appeared for the final exam. One student said, there is a 50-50 chance that I will pass. Other student says, God will only help me. Okay, God only knows what will happen to my result. Who is talking in terms of risk? Student 1, because he is able to assign probability. Who is talking in terms of uncertainty? Second student, only God will tell you what will happen to the result. So therefore, that is how risk and uncertainty is differentiated in the capital budgeting. Okay. So risk means, in your book I have written everything. When I will ask you to write, that time you will write. Okay. Risk is the variability in terms of actual return compared with the estimated return. What we estimated versus what is actual, and the deviation which is possible indicates the risk involved. And it is more so in case of capital budgeting, because investment is made now, returns are in future. How to measure the risk? The most common technique of risk measurement is standard deviation. And sometimes when we are comparing two or more projects, then we also use coefficient of variation. Is it right? So all of you please participate in the discussion. I have explained this part, difference between risk and uncertainty. In case of risk, probability can be assigned. In case of uncertainty, there is no way to assign probability. We will call it uncertain situation. However, these two terms are used interchangeably. But don't worry, when it comes to solving a question, they will give you probability or they may not give you probability, and accordingly we will solve. So what is the scope of our syllabus for the next about 1.5 hour to 2 hour? This is our agenda for today. Techniques of risk analysis. They will be divided into 3 types: statistical technique, conventional technique, other technique. Statistical technique will involve probability, variance, standard deviation, coefficient of variation. Conventional technique would involve RADR, risk adjusted discount rate, or certainty equivalent, and some other advanced technique of risk analysis would include sensitivity analysis, scenario analysis, simulation analysis, and decision tree. So are you ready for risk analysis and capital budgeting? Right. So what is risk? Risk, as we have been discussing, is a situation where actual outcome can deviate from the expected outcome. BCom exam and CA exam and IAS exam, which is riskiest exam? IAS. Which is least risky exam? BCom. How did you come to that conclusion? Because here what we expect and what we get are almost same. Here what we expect and what we get is very different. Here it is different but within manageable limit. Is it right? If you study hard, you will pass the CA exam. If you study very hard, still there is no assurance that you are going to pass IAS exam. Is it right? I have passed these 2 exams. This also I tried. 4 times I tried. 4 times I passed prelim exam also. 4 times I passed prelim exam, 2 times I passed main exam also. Okay, but again, you have limited number of seats. You have other candidates also. So that is why we say IAS exam is risky, and that is why many people will not like to try. Next point. Same logic applies to projects also. If you think projects have very high degree of risk, you will not accept it. You will not accept it. And if you think the risk is within manageable limit, you will accept the proposal. Okay. Risk refers to variability of return from those that are expected. So what you expect and what you may get may have a variation, difference. Risk means probability of losing money. Risk means probability of losing money. That is what is risk in the current chapter, capital budgeting chapter or financial decision making. Risk refers to volatility of return. That is what we expect and what we get can have huge volatility. Risk can be measured by assigning probabilities. But one good thing about the risk is that risk can be measured. Risk can be measured by assigning probability. Next question is, other things remaining same, project which carries lower risk will be preferred. If there are 2 projects, expected NPV is 6,000 for both of them. Expected NPV is same, but their standard deviation maybe 100 and 120 for example, which one will be selected here? If both are having same expected NPV but project A has lower standard deviation, A would be selected. So one more golden rule for today: if the institute gives you 2 or more projects and asks you to select one of them, if their expected NPV is same, then the one with lower standard deviation will be selected. And if their expected NPV and standard deviation both are different, we compute what is known as coefficient of variation. Yes, coefficient of variation, and then we will take a decision. Next point in your book, what is uncertainty? Uncertainty means probability cannot be assigned. An uncertain situation is more riskier than a risky situation. True or false? Uncertain situation is more riskier than a risky situation because you can't even assign the probability. Okay. Now we'll come to what is probability. Long back in foundation course, they used to teach you probability means possibility of happening or non-happening of an event. And what is the range of probability? 0 to 1. 0 means it will not happen. 1 means it is definitely going to happen. Is it right? So how many? There will be 28 hours in a day. What is the probability? 0. If you toss a dice, what is the probability you will get 8? 0. There is no 8. Is it right? But if you throw a dice, what is the probability you will get 2? 1 by 6, because each number has 1 by 6 probability. Is it right? If only one student runs in the race, what is the probability he will win? 100%. 1, because there is only one person who runs. So that is the range. It can't be negative, it can't be more than 1. Sum of all possible event is 1 or 100%. So that is one small cross check in your calculation sometimes. If there are more than one possible event, then the sum total of all probabilities will be 1. So like in a coin, there is a half chance that you get head, there is a half chance you get tail, but the total will always be 1. How do we assign probabilities? There are two ways. One is called objective analysis and one is called subjective. Objective means simply you have past data. What is the probability that a machine will generate positive NPV? If I have used 10 machines in the past, if I have got history of 10 machines, if I have a data of 10 machines we have already used in the past, 4 of them generated positive NPV and 6 of them generated negative NPV. So I will say there is a 40% chance of positive NPV because I have past data. Is it right? And what is subjective? Subjective means it is based on expectation of the decision maker, based on judgment of the decision maker. So decision maker will only based on his experience, he will say, I believe there is a 40% chance that machine will generate positive NPV. So that is subjective. Next is we have to compute expected value. What is expected value? Expected value is called average value or mean value. Average value or mean value. And it is calculated by multiplying the respective values with their respective probabilities. Formula for expected value is sum of probabilities into values. For example, cash flow can be 100, 200, 300 and the probabilities are 0.3, 0.5, 0.2. they have asked you what is the expected cash flow. What is the expected cash flow? Please try and reply. Expected cash flow, please try and reply. How much is that? 190. This is 30, 100, 60, 190. This is called expected cash flow, average cash flow, mean cash flow. Sir, why it is average? There is simple logic. Let us say in the past I have used 10 machines. In the past I have used 10 machines. 3 machines generated 100 cash flow. 5 machines generated 200 cash flow and 2 machines generated 300 cash flow. If you are a school level student and your teacher says find the average of these numbers, you got 100 3 times, you got 200 5 times, you got 300 2 times, and the total number of observation was 10. So if you do mathematics, what is this? What is this called in your school level mathematics class? Average. This is called average in schools. In final it is called expected value, because past is not the guarantee of future. Hence the word expected is added here, but at least it is some basis for decision making. Expected value is not a guaranteed value, but expected value is the basis for decision making. Otherwise, how will you take the decision? Is it right? If you want to go to Kashmir, you will want to go in Kashmir in November. What is the thing you check there? Average temperature. Okay, so suppose last 5 year average temperature is, let's say, 5 to 7 degree average. You would like to go there, that much you can manage. But after you reach Kashmir, it is -2, -10. You can't blame anybody. These are average, expected, actual can be different, but this is the basis for decision making. Okay. What is joint probability? Joint probability means probability of two events happening together. What is the probability that event A will occur and B will also occur? Okay. So what is the probability that Rohit Sharma will make century? Probability of Rohit Sharma will hit a century is suppose 50%. Probability India will win. Independent probability is 50%. What is the probability that Rohit Sharma will hit a century plus India will win? What is the probability that Rohit Sharma will hit a century and India will win? So you can't say 0.5 plus 0.5. Rather it will be 0.5 into 0.5, 0.25. In the capital budgeting chapter, probability of cash flow of year 1, cash flow of year 1 is 0.5, 5 lakh rupees. Cash flow of year 2 will be 10 lakh, is 0.5. The question will be, what is the probability of getting 5 lakh in year 1 and 10 lakh in year 2? What is the probability of getting 5 lakh in year 1 and 10 lakh in year 2? So your answer will be 0.25. That kind of situation we are going to tackle in 2 or 3 problems in our notes. It is calculated by the product of the probability of 2 independent events. This much knowledge is enough to pass this exam. Okay, we are not here for learning statistics, but only to the extent the statistics will be required in our current chapter, we are going to discuss that much. Now next is the formula of risk. Risk is measured by standard deviation or variance. Is it right? Why standard deviation is used? Because standard deviation measures how much the data will deviate from the expected value. Standard deviation measures how much the data will deviate from the expected value, and higher the deviation from expected value, higher is the risk. Lower the deviation from the expected value, lower would be the risk, and therefore we use standard deviation for measuring the risk. Now the next issue is how to compute standard deviation. There are two formulae. If you have studied portfolio management chapter, you will recall. First formula is when number of observations are given. When you are given history of last 5-10 years, then the formula is under root x minus x bar square upon n. And when the probability distribution is given, the standard deviation formula is sigma equal to under root summation probability into x minus x bar square. So we are going to use this formula more often in our current chapter, and this formula was already used in portfolio chapter many times. I hope it won't be difficult for you. Okay, so standard deviation is used for measurement of risk. Square of standard deviation is called variance. Be careful with these terminologies, which means if variance is given, then standard deviation can be computed by taking square root of variance. Then why do we use standard deviation more? The reason being, the unit of standard deviation is same as unit of the data. Unit of the standard deviation is same as the unit of the data. If data is in percentage, standard deviation is also in percentage, but variance is in percentage square. Difficult to compare these two, but easy to compare these two. Okay, so standard deviation is a popular method of measuring the risk. How do you explain standard deviation? Higher the standard deviation, higher the risk. Lower the standard deviation, lower the risk. So when you are comparing two projects which have equal expected NPV, but their standard deviation is different, select the option with lower standard deviation. Below that we have written something about variance. It is the same like standard deviation, except that here we do not take the square root. Here we only take the squared deviation. Is it right? Let us solve question number 4 on risk analysis. Question is taken from May 99 exam for 14 marks. First time it was asked in the history of our exam, May 99, and it is now in the study material also. It was there in the RTP also. Very important tick mark. This question was repeated also somewhere in year 2012 or 13. It was repeated also. AS Limited is considering two mutually exclusive projects X and Y. Project X cost rupees 30,000 and project Y cost rupees 36,000. This is their cost individually. You have been given the below NPV. NPV they have computed for both the projects, and they have also assigned the probability. First question is nothing but bonus mark, easy question. Compute expected NPV of both the projects. Second is compute the risk attached, means standard deviation. Risk attached. Which project do you consider more risky and why? Higher the standard deviation, higher the risk. So we have to see which of the two projects have got higher standard deviation, and next is compute the profitability index of each project. Profitability index formula is present value of cash inflow upon present value of cash outflow, and outflow is given in the top first second line. Project X 30,000, project Y 36,000. You have to somehow find PV of cash inflow so that you can compute the profitability index. But first answer first. Write down in the notebook. Everybody should write in the notebook for more clarity. When you write on your own, you learn more. Computation of expected NPV for project X and project Y. Heading should be written before the table. Computation of expected NPV for project X and project Y. Come on student, draw this format. NPV in bracket X, probability in bracket P, expected value P into X, and draw one little thicker line here. This is dividing the two projects. NPVY, probability, expected value, probability into NPV. So I am going to solve X now. These are the cash flows. Can you see that? These are the probabilities. You will give me total of third column. Anybody 9,000? Check the answer. You are right, 9,000. Now you will try in the same format. Try in the same format for other project. How much is that? 9,000. Is it 9,000? Very good. Next heading, write down calculation of standard deviation. Calculation of standard deviation. Format is, you must have already used it in your portfolio chapter. Project X, under that three column, NPV in bracket X, probability P, X minus X bar square into P, X minus X bar square into P. Project Y, three columns, and now first two columns you will copy from the question book. First two columns copy from the question book. Then you write down 3000 minus 9000 square into 0.1. How much? The expected value was 9,000, am I right?
Yes.
So you have to deduct 9,000 every time from the first column. Kindly reply. Is it 36 lakh?
Yes.
Very good. Next one, try. Anybody? Next one. 36 lakh, first one. Second one, again 36 lakh. Oh, wonderful. Next one, again 36 lakh. Amazing. Come on, next one. Next one, 36 lakh. Total 1 crore 44 lakh. Total is 1 crore 44 lakh. Then come to project Y. Project Y, take the first two column figure. Now again try. What was the average here? 9,000? 9,000. Okay. 72 lakh. 27 lakh. Very good. Next one. Next one. 27 lakh. Last one 72 lakh. Total of the last column 1 crore 98 lakh. Is this standard deviation or is this variance? This is variance. So you can just mention here sigma square if you have space. Sigma square equal to, this is also sigma square equal to, but I need to take the square root of it. Write down please. First write down below sigma for project X equal to, write the formula first, under root summation P into X minus X bar square. This formula is not new to us. Under root 1 crore 44 lakh. Anybody? 3794 point something. Okay, that is okay. 3794 point something. Now you try below standard deviation for project Y. Standard deviation for project Y. 4450. Very good. 4450. My second question was compute the risk. Done. 4450 is right. Can I go to the next question number Roman 3? Which project do you consider more risky and why? Write down for that. Write down answer of 3. Project Y is riskier. Project Y is riskier because the standard deviation is higher. Because the standard deviation is higher. Okay. Now my next question to all of you is, which you will first try and reply, profitability index. Calculation of profitability index. Calculation of profitability index. Calculation of profitability index. Write down right hand side 2 column project X and project Y. I will give you 30 seconds. 30 seconds to try and give me the answer for project X first. 30 seconds for the student to try. What is profitability index of project X? 30%. 30% is not right. You have to answer 1 point something. 0.01. Anybody else? Those who are learning online can also answer. What is the profitability index? This is an easy question from your intermediate. Profitability index, PV of cash inflow upon PV of cash outflow. What is the answer? First you tell me PV of cash outflow. Write down 30,000 and 36,000. See the formula for NPV. Remember your intermediate happy lucky days. NPV equal to PV of cash inflow minus PV of cash outflow. I need this. If I need this, PV of cash inflow will be equal to PV of cash outflow plus NPV. Do you agree? This is outflow. Add expected NPV, which is 9,000 for each of them. Therefore, PV of cash inflow would be A plus B. PV of cash inflow would be 39,000 and 45,000. And therefore, profitability index will be PV of cash inflow, this line, divide by point A, point C divided by point A. Now your answer is 1.3 is right. You said 30%, that is not right. You have to write properly 1.25. Any query on this? If you have no query, then this answer is over. No query? Can we move to the next question or next topic for discussion first? Coefficient of variation. Coefficient of variation is a relative measure of risk measurement. Is a relative measure of risk measurement. When you are comparing two or more projects, and if their expected NPV is different, let us say 12,000, 15,000, and their standard deviation is also different, say 1,500, 2,800, like that. Is it right? Then it is difficult to compare only on the basis of expected NPV or only on the basis of standard deviation, because here you are getting high return for a higher risk also. So in coefficient of variation, what we do, we compute risk per unit of return, risk per unit of return. So where the formula is standard deviation upon NPV. So what is standard deviation upon NPV in case of project A? 0.125. Here 0.187. 0.187. So we'll say B is relatively riskier than A. Project B is relatively riskier than A. Project B is relatively riskier than A. So that is where coefficient of variation provides you a much better insight into the risk. Coefficient of variation is used by the management also for, we will see after some time, what is called risk adjusted discount rate. That means if a project has a higher coefficient of variation, like in this example, B will be discounted at a higher rate and A will be discounted at a lower rate because B is relatively riskier, correct? Higher the coefficient of variation, higher is the relative risk. Higher is the relative risk. Relative risk means with respect to each other. In our example, B is relatively riskier than A. Formula: standard deviation upon expected NPV or average NPV. R means average NPV. There is one example also printed in the book. There is one example printed in the book. An investor is evaluating two securities. Actually, this example we have discussed in portfolio chapter also. If you look at the return, B is having higher return, but at the same time B also has a higher standard deviation. In absolute terms, B is risky in terms of total risk, but in terms of relative riskiness, A is relatively riskier because its coefficient of variation is higher. Okay, so that is the purpose of computing coefficient of variation. How it is applied in capital budgeting chapter? Let us see question number 5. Question number 5 will help you with one more practice on standard deviation, and also you will learn how to compute coefficient of variation. Very important, we are going to use this concept in some more problems in the coming days. Write down. First you read the problem taken from your study material. Calculate coefficient of variation of project A and B based on the following information. So bring before your eyes the formula standard deviation upon expected value. Is it right? And how do you get expected value? Just multiply these two. Just multiply these two. But to get the standard deviation, I have to apply the formula. Is it right? Summation p into x minus x bar square, and we'll take the square root. So accordingly design the answer. First write down step 1. Write down little fast. It's nothing much to explain. Already we did the previous question number 4. So I am not explaining much the first part. All of you are requested to please write down step 1. Calculation of expected value for project A and project B. Write down first column, write down possible event. First column, write down possible event. Under that write down project A, 3 columns. Project A, project A 3 column, cash flow column, probability column, expected value column. Project B 3 column, cash flow column, probability column, expected value column. I have nothing much to add in your knowledge base here. Only you have to practice on your own without reading the answer. Write down cash flow from the question book. Write down probability from the question book, and please on your own multiply and give me the total fast so that I can move ahead. Is it 14,000 and 18,000? Or you can just mention yourself 14,000, 18,000. We can check later. Done. Now write down calculation of standard deviation. Calculation of standard deviation. Under that we have two projects, project A and project B. Under project A we will draw 3 columns: cash flow, probability. Under cash flow you can write X, under probability you can write P, and here you can write X minus X bar square into P. Is it right? Then write down here cash flow Y, probability P, and you can write Y minus Y bar square into P. What is X bar here? 14,000. So you can mention here X minus 14,000 square into P. And what is your 18,000 for project B? So you can mention Y minus 18,000 square into B. Cash flows are given like this. 10,000, 12,000, 14,000, 16,000 and 18,000, correct? Probability 0.1, 0.2, 0.4, 0.2, 0.1. Now the student will help me with the answer. 10,000 minus 14,000 square. Is it 16 lakh? Final answer here. Next one. 8 lakh. Very good. Next one. 0. Next one again 8 lakh. And the last one 16 lakh. Very good. Anybody for the total? This is sigma square equal to 48 lakh. Press square root function. Press square root function. 2191. 2191. Not very difficult. Now cash flow of project Y 26,000. If you practice, you will not take much time. Only if you keep on watching the video, you will not understand on your own. Best way to learn AFM is to practice. Probability 0.10, 0.15, 0.50, 0.15, 0.10. First one is how much? 64 lakh. Then 24 lakh. Very good. Next one 0. Again 24 lakh. 64 lakh. Wonderful. Amazing. Total 1 crore 76 lakh. So sigma will be square root of this number. 4195 approximately. Very good. If you look at the answer which is printed in the book, they have done by formula, we have done by tabular method. Whichever one you want to try, you can try in the exam. There is no harm. Now write down coefficient of variation, calculation of coefficient of variation. Calculation of coefficient of variation. Calculation of coefficient of variation. After that, draw this table. Project coefficient of variation, risk and expected value. So project A and project B. Refer your previous two answers. The formula for coefficient of variation is sigma upon mean. Is it right? You can write the formula in the heading here, sigma upon mean. Sigma upon expected value. 2191 divided by 14,000. How much? 0.1565. Very good. Next one, try yourself. 0.2331. Approximately. 0.2331. Approximately. Now, in terms of risk, which has lower risk relatively? A has lower risk. This has higher risk. In terms of expected value, A has lower expected value, B has more expected value. So if you have to take a decision based on coefficient of variation, if the decision is to be based on coefficient of variation, then project A would be selected. Is it right? So write down, in project A, risk per rupee of cash flow is 0.16, while in project B it is 0.23, while it is 0.23 in project B. Therefore, project A is better than project B. Therefore, project A is better than project B. We have discussed statistical techniques of risk measurement. Understood? In statistical technique, we have used the concept of probability, standard deviation, variance, coefficient of variation. Now we'll go to next risk measurement technique called conventional technique. Under conventional technique, we are going to first discuss risk adjusted discount rate, highly popular for exam purpose also, for classroom also. What is RADR? RADR simply means that if the project is more risky, use a higher discount rate. If the project is less risky, use a lower discount rate. Higher the risk, higher the discount rate, lower the risk, lower the discount rate. Okay. Then there are some examples I have added in your notes. If there are two proposals, one is cost reduction proposal and one is revenue expansion proposal. Example, which of them will be discounted using higher discount rate and which of them will be discounted using lower discount rate? Tell me, which of them will be discounted using higher discount rate? Expansion. And lower discount rate? Revenue. Cost. Expansion proposal will be discounted. One more example. One is expansion and one is introduction of a new product. Which one will be discounted at a higher rate? If I have to launch a new product, is it right? If suppose I am teaching CA final, but now from tomorrow I want to sell trucks. Or should I add some more franchisee, which is easier for me? Adding more franchisee because I know the model, how it works. I have never done truck business, so that is riskier for me. Example only, I am not going to start. Therefore, we have to use higher discount rate. How do I adjust risk? By adding risk premium. By adding risk premium. Higher the risk premium, higher is the risk adjusted discount rate. If required, we will use CAPM formula for adjusting the risk if required, depending upon the data given. So one of the methods of understanding the risk is beta. So if you are given beta in the problem, then this will help you to compute the risk premium. Add that to the risk-free rate and that will give you required rate of return of the project. Higher the beta, higher the risk, higher the risk, higher the risk premium, higher the risk premium, higher the required rate of return. In some problem they will give you risk premium based on coefficient of variation, then accordingly you adjust the risk premium. Okay, risk premium plus risk free return is equal to RADR, but this risk premium they will give you some hint how to calculate this. One method could be, for example, CAPM formula for adjusting the risk. High risk project risk premium is high, low risk project risk premium is lower. So now I am going to take one question, but before that there is a small theory question. Advantages of RADR. First advantage, easy to understand. You have understood it? Yes? Easy to understand. And it is easy to incorporate risk premium. There is one more method after this certainty equivalent coefficient, where we have to convert a risky cash flow into risk-free cash flow. That is more subjective compared to adjusting the risk premium in a discount rate. And what are the limitations or disadvantages of this method? As you can understand, adding risk premium is subjective. What is exact risk premium is a subjective exercise. Okay. So under this method, NPV can be computed, but standard deviation cannot be computed. So these are some of the challenges or limitation. If they ask you for some theory question, you can write. But the important point is, one, difficult to identify exact risk premium. Risk is subjective. Okay. Highly tested question in the exam in the past. Question number 6. Determine the risk adjusted NPV of the 3 projects. 3 projects are given: A, B, C. Initial investment, project life, annual inflow, coefficient of variation. We have just now discussed coefficient of variation. They have found these are their respective coefficient of variation. The company selects RADR on the basis of coefficient of variation. So now you reply, for project A, what is RADR? 0.4, 12%. What is RADR for project B? 0.8, 14%, because relatively it is riskier. C is the riskiest project in relative terms, so therefore C would be discounted by the highest rate, 16% in our example. Then why they have given 1.6, 18%? To confuse you. Is it right? Only 12, 14, 16. And one more good thing, PV factors are already given. Only you have to just multiply this annual cash inflows by these PV factors and deduct the initial investment. That will give you risk adjusted NPV. They have not asked which project should be selected. If they ask, then as usual, the project which has highest NPV should be selected. So let us solve it in a simple manner by preparing 3 formats for 3 projects. You can do in one format also, no harm. NPV of project A, write down calculation of NPV of project A. All of you please participate in discussion. Calculation of NPV of project A. I am going to follow the same basic presentation for NPV. Year particular cash flow discounting factor at 12% and last column present value. First write down year 0, cash flow 1 lakh, discounting factor 1, present value 1 lakh. Presentation should be smooth, easy for examiner to understand. Now write down 1-5 cash inflow 30,000. Is it right? 30,000? Okay. Factor from the book 3.605, 1,08,150. Factors are given. Please solve using same factor. 8150. Very good. Now write down below in the same format NPV of project B. For project B, we will use 14% discount rate. Year 0 cash outflow for project B, is it 1,20,000? And year 1-5 cash inflow is given for project B 42,000. Factor at 14%, discounting factor at 14%. Come on, 3.433, 144, 186. Finally, what is NPV? 24186, is it right? 24186. Come on, you will try now project C yourself and give me the answer. Final answer. One student is saying 19,180. You are right. Amazing. Wonderful. 19180, you got it? Very good. So this was the answer. If they ask you which project should be accepted, then on the basis of NPV, the one with highest NPV will be selected. Project C, B, okay, project B, but don't write because that is not a part of the question. Now one good question from your study material again, and this is a November 2009 10 mark question, repeated also. New Project Limited is evaluating 3 projects P1, P2, P3. Following information is available. P1, P2, P3. Cost, inflow. Now inflow for 4 years are given, but for project 1 inflow is same, so you can use annuity. But for the other 2 projects, cash flows are different in each year, so you have to prepare table. And this time the risk premium will be based on beta. Higher the beta, higher the risk, higher the risk, higher the risk premium, and higher the discount rate. They have written the minimum required rate of return of the firm is 15%. The risk-free rate of interest is 10%. Compute the RADR for these projects and then which project is the best. This time they have asked you which project is the best, but my question is how to compute RADR? CAPM formula. In CAPM formula we have RF given plus beta given, RM, but RM is not given. Instead of RM they have written this minimum required return. So this will be interpreted as RM because there is no other information. They should have written market return, something like that. But since this is the terminology used, it will be interpreted as RM. Okay. First step would be to find out RADR. Step 1. First step would be to find out RADR. Step 1. Under that write a note. Under that write a note. The RADR can be found out by using the principles of CAPM. That means we are going to use CAPM principles. Even though market return word is not mentioned in the problem, we will use minimum return given in the problem as a substitute for market return. Okay, right. One table. Risk free return. Second column write minimum required return. Second column write minimum required return. Third column write down risk index in bracket beta. Risk index in bracket beta. And fourth column RADR. RADR equal to RF plus risk index into K minus RF. One I will solve you, two you will solve for me. Case 1, risk index is 1.8, first project. Can you see that? Formula of CAPM will be applied by the student and answered. 19% is right. Come on, next. Try next one. Try next one. Answer please. Is it 15%? Is it 15%? Yes or no? And last one. Is it 13%? There is no alternative but to use this formula and to use this 15% in place of RM. Okay. So this way, if questions like this are asked, this way you will first find the RADR. Now one by one we will solve NPV of project 1. NPV of project 1. Year, particulars, cash flow, discounting factor at 19% and present value. So learned students will start writing year 0 investment. How much is that? 15 lakh. And year 1-4 annual cash inflow 6 lakh. So try to solve yourself. Approximately your answer would be 83,400 plus minus few hundred rupees is possible. Plus minus some amount is possible. Okay. So I am getting 83,400 because I have taken 3 digits. 83,151. You may get 83,151. Welcome. You are right. Try next. Step 3. PV of project 2. PV of project 2. Same format. Any other format is also welcome, as long as you get the same response, same result. I have no problem. You can follow direct calculation also. These are the cash flows of project 2. What was the discount rate for project 2? 15%. Try at 15%. Try at 15%. You can use 3 or 4 digits in the factor. Maybe you can write directly the last column also. On your calculator you can find the present value and write in the last column. Both are welcome. Anyone who got the NPV of project 2 will reply. Anybody NPV? 167, 290. Okay. 167, 290 is another answer possible because of rounding off. Is another possible answer, which I will give it as a full mark, no problem. Can we try project 3 now? Yes, try project 3 now. On your own, try project 3. I will give you the cash flows as per project 3, and the student will apply 13% discount rate. Please reply. All the students should reply. Yes, try please. Two lakh 14,300. 2,14,300. कोई बात नहीं, 2,14,300. That is also okay. Now which is highest? First one is highest. Third one is highest. Okay, so then write down project 3 has the highest NPV. Project 3 has the highest NPV. So it should be accepted by the firm. So it should be accepted by the firm. So it should be accepted by the firm. So that was one more example on RADR method. Another approach is called certainty equivalent approach. In risk adjusted discount rate method, what we do, in risk adjusted discount rate method, we adjust discount rate. In certainty equivalent approach, we will adjust cash flows. We will convert risky cash flows into its equivalent risk-free cash flow, into its equivalent risk-free cash flow, and then use risk-free discount rate. That is, discount rate will not include risk premium because cash flow does not include risk premium. Is it right? So risk-free cash flow will be discounted using risk-free discount rate. How do I convert? This is the main task. How do I convert risky cash flow into risk-free cash flow? So here the concept is, if cash flow is risky, but if I tell the decision maker, had there been no risk, how much cash flow you would have accepted? So suppose uncertain cash flow is 100 rupees, but I am willing to accept 90 if that risk is involved. If somebody is willing to give me guarantee, I am willing to accept 90. 100 means I may or may not get. 90, somebody is willing to assure me. He says, don't worry, I will buy at 90. So 90 is my equivalent risk-free cash flow. Okay. To understand this concept, let us also understand one small story. Okay. Suppose this is your house. Okay. There is a tree also. I know it's not very nice looking, but it's okay. Considering the time, you want to sell this house after 1 year. So let us say Mr. A wants to sell this house after 1 year. So what is the cash flow he is expecting to receive? So I'll give you some number which is also printed in your book. So in future, in case if you are interested to read the same story, the story is there in the book. Let us say he is expecting to receive 6,20,000 after 1 year. You don't have to write anything. The story is already printed. Tell me, is this 6,20,000 risky cash flow or a risk-free cash flow? Risky or risk-free? Risky, because he is expecting that he will be able to sell this house after 1 year for 6,20,000, but he may or may not realize that. So if the cash flow is risky, he would use a risk adjusted discount rate. So his risk adjusted discount rate is high, 14%. So what is the present value of this 6,20,000? The present value will be 6,20,000 divided by 1.14. 5 lakh? 43,860. But then Mr. A has a neighbor who stays nearby. He thinks that he should buy this house because then he will have two houses next to each other. So he says, Mr. B tells Mr. B, don't worry, I am willing to give you a guarantee that I will buy your house after 1 year. Will Mr. A still charge him 6,20,000 or less than 6,20,000? B is willing to give a guarantee on a stamp paper in writing that I am willing to purchase after 1 year. He will charge less, but the question is how much less? So reverse working. Mr. A wants in present value terms 543,860, but now he is going to apply risk-free rate for decision making. Let us say risk-free rate is 6%. Let us say risk-free rate is 6%, but Mr. B will pay after 1 year. Mr. B will pay after 1 year, so I am going to add 1 year interest, 6% interest. 576,492, something like this. It's printed in the book also, so the students need not write. 576,492. Can I now conclude my story by saying 576,492 risk-free cash flow is equivalent to rupees 6,20,000 risky cash flow. So that is how risky cash flow is converted into risk-free cash flow. Okay. So there is a concept called certainty equivalent coefficient. Certainty equivalent coefficient, which is the ratio of risky cash flow upon risk-free cash flow upon uncertain cash flow. In our example, in our given example, 576,492, take calculator, divide by 6,20,000, how much do you get? Something around 0.929 you are getting, again printed in the notes, so don't worry. Now how do you interpret this 0.929? If the cash flow is 1 rupee, which includes risk premium, risky cash flow, uncertain cash flow, the decision maker is willing to accept 0.929 risk-free cash flow. The decision maker is willing to accept 0.929 risk-free cash flow. Is it right? Suppose you are a student, you will say, no, I will appear for CA final exam and I will get 70 marks. The institute says, suppose you don't appear, but I'll give you 50 marks and I'll pass you. Will you accept it? No. Everybody will accept. So my 50 marks risk free is equivalent to 70 risky cash flow, uncertain mark. Is it right? So if I try, I will get 70 marks, but that is uncertain. You don't know what can happen in the exam. Is it right? But institute says, forget your exam, don't appear, I'll give you 50 marks. So student is saying, I'm willing to accept 50 against 70. So that is my certainty equivalent coefficient factor. Is it right? So I have written this note completely in the book. I will summarize the main points here. Certainty equivalent approach means how much assured sum the decision maker is willing to accept against a risky sum. So it is a ratio of assured cash flow to uncertain cash flow. So what we do in this approach, risky cash flow is converted into risk-free cash flow. Okay, that is the cash flow which management is prepared to accept if there is no risk. Example, a project will generate 20,000 cash flow, but it is uncertain. Management is willing to accept 12,000 had there been no uncertainty. Therefore, in the given example, the certainty equivalent coefficient factor will be 0.6. Okay. What is the range of CEC? Range of CEC is 0 to 1. Okay, 0 to 1. 0 means highest risk, because you will not get anything for that cash flow, and 1 indicates 100% certain cash flow. 1 is indication of 100% certain cash flow. Example, government bond. Government bond will have a CC of 1 because there is no risk. But this is, suppose, loan given to whom? Dawood Ibrahim, my old good friend. Okay, now he stays in somewhere near Pakistan, I don't know. Give him loan and ask for the refund. You will not get anything. That is 0. So if you are closer to 1, risk is less. If you are closer to 0, risk is more. Okay, so they will ask you 0.9 is less risky or 0.7 is less risky. 0.9 is less risky compared to 0.7. Okay, higher the level of risk aversion, lower the certainty equivalent factor. Distant cash flows are more risky, therefore certainty equivalent factor will be lower. So this point is important for exam. They will be giving you 3 years data, and the certainty equivalent usually is given in decreasing order. Why? Because as you go more and more into distant future, the uncertainty element is increasing. What will happen after 1 year is easy to project relatively as to what will happen after 3 years or 2 years. Okay, so formula: certainty equivalent factor is equal to certain cash flow upon uncertain cash flow. Certain cash flow is what you are willing to accept against unassured sum. UCF means uncertain cash flow. How to convert uncertain cash flow into certain cash flow? Multiply uncertain cash flow into certainty equivalent factor. So this factor you tick mark, this you tick mark. And the another thing you need to underline, the appropriate discount rate here would be a risk-free discount rate. The appropriate discount rate would be risk-free discount rate. Once again, I have summarized in your book what are you supposed to do. First, you convert uncertain cash flow into certain cash flow by multiplying uncertain cash flow by certainty equivalent factor. Second, use risk-free discount rate and find NPV. Third, if NPV is positive, project is acceptable. Okay, advantages of CEC. simple and easy to understand and apply. Mathematically, it's a very easy portion of our syllabus and it can be easily calculated for different risk level also. Higher the risk, lower the CEC. Lower the risk, higher the CEC. But there are some drawbacks, limitations of this method. There is no objective method or mathematical method to accurately project certainty equivalent. High degree of subjectivity is involved. Different individual can have different certainty equivalent coefficient. So a good student, rank holder in intermediate, he will say, I can get 70 marks, but if institute does not want to conduct the exam, I want 65 marks. But some student will be very glad to accept 50 marks, right? So it involves subjectivity. How much risk-free cash flow one person is willing to accept depends upon the risk perception. Another difficulty is that the risk perception of the management and the risk perception of the shareholder may also be different. Okay, these points are required for theory question or some related MCQ question. One last point before we take one question is difference between RADR and certainty equivalent method. From our discussion you have understood, in RADR method we adjust the discount rate. The project with higher discount rate is discounted using higher discount rate, whereas in certainty equivalent factor method we adjust the cash flows. Risky cash flows are converted into risk-free cash flow and then we use risk-free discount rate to arrive at NPV. Understandable? So I am going to take one question which is from November 99 exam, also repeated in November 2003 exam, also presented in your study material. The November 99 exam was the exam in which I had appeared, which means I have attempted this question in the exam. Okay, still relevant because it's there in your study material also now. ES Limited is considering investment in one of the two mutually exclusive project. Underline. When the problem says one of the two mutually exclusive, means the student will have to make a choice because only one can be selected. Only one of the two can be selected. Mutually exclusive means selection of one will reject the other one. Project A, which involves an outlay of rupees 1,70,000, and project B, which has an outlay of 1,50,000. So these are initial investment. The certainty equivalent approach is employed. The current yield on treasury bill is 5%. Why this is given? This is risk-free rate and this will be used for discounting purpose because you are going to eliminate the risk from the cash flow, and company uses this as a riskless return. Very good. They are trying to help you to pass. Expected value of net cash flows with their certainty equivalent are, these are the cash inflows, these are the respective certainty equivalent. Project B, certainty equivalent. Which project would you accept? Higher the NPV, higher the NPV, that project will be accepted. Very easy question, but that is not the only reason I passed in first attempt in merit. Okay, there were other questions also which were difficult. Second, which project is riskier? How do you know? Look at the question and you can understand. If I take the total of this certainty equivalent of project A, that comes to 2.0, and if I take total here, that comes to how much? 2.3. 1. Second thing, every year also B has a higher certainty equivalent. Higher certainty equivalent means project B is less risky. Individual year also and total also. If individually it was not matching every year, then you can take total and compare. But here on both the fronts, B has higher CEC, therefore B is less risky. How do you know? Because it has a higher CEC. Higher CEC means less risk. If the company has to use the RADR method, which project would be analyzed with higher rate? Project A, because project A is riskier. So the answer of question B and C are interlinked. If you are saying in project question number B that A is riskier than B, then you have to also answer in C, A will be discounted using a higher rate. Both questions are actually same way of asking, two way of asking same question. Two way of asking the same question. So let us write down. First write down in the notebook. I think in your book I have given the format. Can you see that? Those who have the book can write in the book. Those who don't have the book can write in notebook. Project A write down. First write down case 1 project A. Case 1 project A. Come on student, you can do it. Year, cash flow, in bracket risky. Then write down certainty equivalent coefficient. CEC, cash flow risk free. Discounting factor at 5%. Discounting factor at 5% and discounted cash flow. Column number 1, 2, 3, 4, 5, 6. Column number 1, 2, 3, 4, 5, 6. Column number 4 you can compute by multiplying 2 and 3, correct? And column 6 as usual, cash flow into PV factor. Write down the question year 0, 1, 2, 3. Year 0, 1, 2, 3. Copy from the question book. Year 0 investment is 1,70,000. Year 1 90,000. Year 2 1 lakh. Year 3 1,10,000. Certainty equivalent coefficient. Year 0 always 1. Year 0 always 1. Then 0.8, 0.7, 0.5 is given. Please multiply column number 2 and 3. 1,70,000, 72,000, 70,000, 55,000. Can you get it right? Factor. If the factors are not given in the problem, write your own factor. Final answer. Anybody? Final answer? One student has replied 9572. 9572. Is it 9572? First answer, say yes or no. 9572. Okay, project B on your own. This time I will not help you. Project B on your own. Ten seconds more. Project B student will solve on your own. Question is also in the study material. Everybody should reply. Only few students are replying. Haji? One student have already replied 44,276. First question is, which project should be acceptable to the company? Write down decision. Write down below decision. Since the NPV of project B is higher, project B should be accepted. Check the answer again, 44276. Okay. Anybody major difference? No major difference? Right. Please write down decision. You have to conclude the answer by writing a decision. Since the NPV of project B is higher, project B should be accepted. Then write down second answer, certainty equivalent coefficient of project A is 2 bracket, in bracket, how did you get 2? 0.8 plus 0.7 plus 0.5. Which is lower than project B, which are lower than project B. 2.3. How this 2.3 you have got? In bracket 0.9 plus 0.8 plus 0.6. This means project A is riskier than project B. This means project A is riskier than project B. As higher the riskiness of cash flow, and this is the reason, as higher the riskiness of cash flow, lower will be CE factor. Correct? Have you noted? And the same answer for the third part. If you are saying project A is riskier, you are also saying you should use higher discount rate for project A. Answer of third part. Please note it down. If RADR method is used, project A would be analyzed with a higher rate. The cash flows from a more risky proposal, should be discounted at a relatively higher discount rate. As compared to other proposals whose cash flows are less risky. Is it right? So that was about certainty equivalent coefficient. Another highly tested question is sensitivity analysis. sensitivity analysis means if any of these factors which affect NPV changes, how the NPV is going to change. Is it right? So there are two types of questions they will ask you here. But before that, I need to give you some background because you are a good student. How is NPV computed? NPV is computed by using following variables. Usually, initial investment, revenue, material, other cost, discount rate, project life. You can add tax. If you want, you can add salvage value like this. Okay. Now, if any of this variable change, NP will change, because while doing a project evaluation, till now what we have done, we have assumed investment will be 10 lakh, cash flow will be 5 lakh, life will be 4 years, discount rate will be 10%, like this. But these are all based on estimation. Estimation can change. So if the estimation changes, how the NPV would change? So one question could be, what will be NPV if the cash flow changes by 5%? Find out the NPV and how much NPV has changed in percentage term. Is it right? But generally they don't ask such easy question, because that is like solving another easy question with a different data. They will ask you, your intelligent, they will test your intelligent, how much would be the increase in initial investment which will make NPV 0. How much can be increase in material cost, other cost, which will lead to NPV being 0. How much can be the drop in sale which may lead to NPV being 0. So basically we have to do reverse working, find out the value of a particular variable at which NP will be 0, keeping other factors constant. In sensitivity analysis, we are going to test only one variable at a time, keeping other variable constant, and our target is to reach NPV equal to 0. So you have to basically solve an equation. How do you compute NPV? NPV is equal to, for example, quantity into sales or selling price. When I am writing quantity, selling price minus variable cost minus any cash fixed cost, minus any taxes, and all these multiplied by PV annuity factor, again minus initial investment. This is just a simple example, minus initial investment. Is it right? And you have this value as 0. If they are asking you to test the NPV or sensitivity for, let us say, fixed cost, this you take as X, take all other variable given in the original question. If they are asking you to test it for quantity, take quantity as X, keep all other variable as it is. If they are asking you to test for selling price, keep selling price X, put all other variable as given in the problem, and then find out how much percentage change in that variable will lead to NPV equal to 0. That means any change more than that will lead to NPV becoming negative. More than that will lead to NPV becoming negative. Second thing, when you are testing for sensitivity, you look at only downside risk. You look at only downside risk. Downside risk means, suppose example, sales. What is the risk with respect to sale? Sales may fall. But what is the risk with respect to material cost? Rise. What is the risk with respect to other cost? Rise. What is the risk with initial investment? It may rise. What is the risk with respect to discount rate? It may rise. But what is the risk with respect to project life? It may be less. You are expecting to receive cash flow for 5 years, but probably after change in technology, change in government policy, it may not go up to 5 years, and project might have to be scrapped after some earlier period also. So you have to only look at the downside risk, find out how much percentage change will lead to zero NPV. The one which will have lowest percentage means project is more sensitive to that variable. Project is more sensitive to that variable which have lowest sensitivity percentage. Example, 2%. Suppose you did the calculation and it comes like this. If I ask you, project is most sensitive to which of these variable? So you have to search for the lowest figure. Discount rate? Is it discount rate? It means if the discount rate increases by 1%, NP will become negative. NP will become negative. So project is very sensitive to discount rate. And if they ask you to rank in order of sensitivity, the second rank will go to material, third rank will go to other cost, and like that. Is it right? So some intelligence will be tested. Good news. I have written all the notes in your book. I am going to read the important lines. Rest you can read on your own. What is sensitivity analysis? It is used for measuring the risk. And this is very important. As a businessman, you should know how much risk you are taking, because if suppose sensitivity of sale is 5% only, that means if sales falls by more than 5%, you will have a negative NPV, and in the uncertain world, sales may drop by more than 5%. Okay. So it helps in assessing information as to how sensitive are the estimated parameters of the project. That is, how sensitive the project is to cash flow, discount rate, project life, to the estimation error. The whole capital budgeting is based on estimations. And we have to also know, if a certain estimate changes by a certain percentage, I can get NPV negative. But that percentage of error, the margin of error, if it is very low, the risk is very high. Simply put, if your exam has a passing percentage of 50, you still can make mistake in 50% of the questions. But in CPA exam, you need 75% marks per paper. They don't even do averaging. Averaging means 70 and 80, means this is pass, this is fail. In C exam, 45 and 55, both you will pass. So where the sensitivity is more, CPA exam, you can't make mistake there. Okay, because you only 25% safety margin there. Okay. Then sensitivity analysis takes care of estimation your errors by using a number of possible outcomes in evaluating a project. So what is sensitivity analysis? It is a technique of risk analysis which studies the responsiveness of a criteria of merit like NPV or IRR to variation in underlying factors. That is how the NPV or IRR may react if selling price changes, quantity sold changes, or return from investment changes. So in sensitivity analysis, the decision maker is thinking like this: what if the cash flow is 50,000 instead of 80. Will I still get positive NPV? What if the life of the project instead of 5 years, suppose turns out to be 3 years, will I still get positive NPV? So in sensitivity analysis, what you will do, you will first identify in the question which are the variables which will influence IRR or NPV. Mostly in our exam, NPV is tested. Then you have to find out what is the mathematical relationship between this variable. I have told you just now, quantity in bracket selling price minus variable cost minus cash fixed cost minus tax into PV annuity factor minus initial investment is equal to NPV. So based on question you decide the equation. It can vary from question to question. Some question may not have taxation, some may have taxation, some may have depreciation, some may not have, some have salvage value, some may not. And analysis of the impact of changes in each of the variable on the NPV of the project. How, if any of these variable changes, NP will be affected. That is what sensitivity analysis is all about. Again, I have written some steps here. First step is each input variable is considered separately. That is one drawback of this method also. What is the drawback? You will only test one variable at a time, keeping other assumptions constant. Okay, this is one of the limitation or drawback of this method. Practically more than one variable can change simultaneously. To overcome that problem, we compute what is called simulation or also called scenario analysis. After this, the next two methods, scenario analysis and simulation. Then find out the extent of change in an input parameter that would result in zero NPV is computed. So your intelligence lies here. You have to find what should be that value of that input at which NP will be 0, and then you express that in percentage. And this you are going to apply for all critical variables. As a student, institute will give you which input you have to apply or test for sensitivity. In a question there may be 10 variables, but institute may only ask you to test 3 or 4 of them. So only test what is asked. Only test what is asked, and if nothing is asked, all variables you have to test. Okay. And for the decision maker, if you think that a particular variable may change more than what you have computed, think again whether to start this project or not. Suppose sensitivity of sale is only 5%, but you think that because of high uncertainty the sales can drop by more than 5%. You have to think again whether I need to start such project which have only 5% margin of safety with respect to sales volume, because sale is not in our hand. Is sales in our hand? No, sales is based on customer. Therefore sensitivity measures only downside risk. And now the formula for sensitivity: change divided by base. Change means to what extent input can change, at which NP will be 0. And base means the original figure given in the problem. Base means the original figure given in the problem. If for example sales quantity estimated is 10,000, a 500 unit change in sale can make NPV 0, then I'll take 500 divided by 10,000, which comes to how much? 5%, like this. Advantages of sensitivity analysis: company can identify critical variable which can impact the NPV, and then you will focus on those critical variables because they may lead to success or failure of the project. And then second thing, as far as its application is concerned, It is simple because only one variable will be tested at a time. But there are some drawbacks of this method also. One serious drawback is it ignores interdependence. It only assumes independence. One variable will change, others will not change. But that is not how in real life it works. More than one variable can change at a time. If the selling price changes, quantity demanded can also change. Material cost can also change. Then this method does not take into account probabilities. Enjoy. No probability calculation is involved in terms of change in the values of variables. And third is very interesting point. Sensitivity analysis will only calculate the risk. It does not eliminate the risk. That is left to the management. How do you want to eliminate the risk? I will tell you what is risk. I will tell you in C exam you need to get minimum 50%, okay, or average 50%, minimum 40%. That is a risk. How to eliminate the risk? I am not telling you that. Okay, so this is about sensitivity analysis. The institute will ask you, out of the 5 factors, the project is most sensitive to which of the factors? So here, if the sensitivity percentage is lowest, project is most sensitive to that variable. For sales, if the percentage is 5 and for fixed cost it is 10, project is more sensitive to sales. So management has to really work on sales because a 5% drop can lead to reversal of investment decision. So this is about the theory part. Today we'll stop here and we will continue tomorrow. Thank you very much everybody for joining today.